So today we're speaking with Mr. Ronald-Peter Stöferle, partner of Incrementum in Liechtenstein and responsible for their research and portfolio management. You've also co-authored the well-known and wildly popular In Gold We Trust report, which you started in 2007. Ronnie, thanks a lot for joining us today.
Thanks a lot, Scott. Really appreciate it.
Yeah, it's great to catch up with you. I mean, I know you've been a good friend with our CEO, Frank Seuss, and our BFI Capital Group for quite some time already.
Yeah.
And I remember even a few years back when you used to contribute regularly to our Mountain Vision periodicals. And so we look forward to being able to do some more here with our blog too in the future. We've run obviously in many of the same circles for years, thanks to our common beliefs and the principles of the Austrian School of Economics, amongst other things, many other things. And while you've known you for quite some time, there may be a few of our readers and listeners that haven't been introduced to you yet. So, after that brief intro, I mean, can you just tell us a bit more on your background and what you're doing today with Incrementum?
Yeah, of course. Well, I'm 38 years old, father of three gorgeous daughters, which keep me very busy. So actually, the developments on the markets are are nothing against the volatility that I'm facing sometimes.
It builds thick skin in any case, right?
And I've always been very, very interested in financial markets. I bought my first stocks when I was 13. I made quite a fortune and lost a fortune during the dot-com boom. I learned my lessons, studied finance and business administration in Vienna and in the US, and then started as an analyst in 2007 in Vienna.
Okay.
And was basically privately invested in a mining stock that did very, very well. It was a 40 bagger, and I thought that I'm just a financial genius, but I was just purely lucky. But that got me interested in gold, and actually, I think over here in Europe, especially in Germany and in Austria, I think gold is still in our monetary DNA because of the hyperinflation, Weimar Republic, and also before in Austria the hyperinflation. So gold is something that is really important for us. So for every school graduation and birthdays and Christmas, it's just normal to get little gold coins from your grandparents, because for them it was some sort of a monetary insurance during the wars and the monetary reforms that they had to live through. Yeah. So in 2007 I started my first In Gold We Trust report. And then over the years, I learned more about monetary history, because this is something that nobody actually teaches you. I learned more about the Austrian School of Economics, and this is also something that nobody teaches you at schools or university over here in Europe, unfortunately. And at some point, I felt like a bit like the vegetarian in the big butchery, writing about gold and gold standard, but sitting in a bank. And I decided to set up my own company together with an Austrian friend of mine, Mark Walek, who is from the fund management industry, and two partners from Switzerland, which are more senior and have a really, really fantastic background in the private wealth management in Switzerland. So we met up in the middle and set up Incrementum in Liechtenstein. And basically the In Gold We Trust report really tries to make a holistic analysis of the gold market and of its opportunity costs, so interest rates, stock markets, bond markets. We really want to understand the big picture of the market. And we're somewhat proud that nowadays the report really seems to be one of the most widely followed and appreciated reports on gold. Sure. So
you started that in 2007. I mean, did you ever think it was going to grow into what it is today? And I mean, it's got to be a huge labor of love that you're working on, and I know it's grown over time. But I mean, did you ever imagine that it would turn into what it did?
No, never. I mean, just to give you an impression, at the moment, there are 15 people involved in Gold We Trust report.
Wow.
Proofreading, editing, layouting, social media, crunching the numbers, preparing charts, researching specific topics. So it is really a big project for us. And actually, for me, I feel a bit like a distillery because I'm traveling quite a lot. I'm meeting people from all over the world, from different industries. I really enjoy reading books, blogs, newsletters, whatever. And I think I just try to distill all the thoughts and ideas that I have from traveling and reading over 1 year, and I try to distill it for the In Gold We Trust report. So it's very condensed. It's very much information driven, but we also want to make it fun and enjoyable for the readers, because actually our readers give us something very, very valuable, which is time. So I want our readers to say after finishing the report, well, I invested my time pretty well. I really enjoyed reading the report. I learned a lot. Perhaps I had a good laugh watching the cartoons or the side comments. So that's actually what we want to achieve. And for 2019, the big step for us is that we're entering China. So we will be publishing a Chinese edition of the In Gold We Trust report. And yeah, I mean, as I've said, I would have never expected that this report will become such a benchmark report, and that also makes us very, very proud, because we are investing so much love, time, capital, and devotion to this report. And I think that our readers can really feel that.
No, I mean, it certainly is like a Bible, I guess, for everything gold related. And I know, we all look forward to it every year. You just had the launch, I think, on May 28th,
yes,
if I'm not mistaken, in Vienna. And another great issue that you put out. Just to dive into things, you outlined in the latest report that there's an important shift unfolding in the global monetary architecture, with a massive move away from the US dollar and a solid expansion of gold reserves in key countries like China and Russia. How do you interpret the gold buying spree by the central banks, and what do you expect the practical impact of this move to be?
Well, I think it's a sign that many countries are losing trust in the US and also in the US dollar. And actually the topic of trust was the leitmotif of the 2019.
Exactly. Yeah, I love that. I
Trust
mean,
report.
because it's like the key word. I think I just even recently wrote in our blog that how many times you see gold and trust in the same sentence.
Yeah.
So.
And it is something that is, I think, a bit underappreciated. Everybody thinks that trust is just there, but how trust is created, how it's fostered, and how it's destroyed is something that people don't think about too much. And in one of my most recent keynote presentations, I showed that trust is eroding in many areas of our life. And this was also the reason why we chose that topic to be the leitmotif of this year's report. And I think it's important to say that when it comes to trust, it's very asymmetrical. So it takes years or decades to create trust, and it can take only one moment or a day or a week to completely erase that trust. We have seen it with Lehman Brothers, for example. In 158 years of existence, Lehman Brothers didn't have one quarter posting losses. And then basically just a few trading days when the market lost trust in the balance sheet and the liquidity of Lehman Brothers, and it was over. So at the moment, I think we're seeing that trust in institutions such as politics, science, and the media is crumbling. We're quoting quite a lot of quite a lot of studies about that. For example, the General Social Survey. And it says that since 2000, confidence in virtually all institutions has eroded, with the exception of the military. So at the moment, only 1 in 5 persons still has confidence in banks, churches, or big business, and only 1 in 10 has confidence in the government. And it's not only in the system, it's also trust in, of course, in our democracy. There's a study by Neil Howe, and he really did a tremendous job researching those topics. Actually, that the young generation, they don't have any trust or any confidence in democratics anymore, in
democracy.
democracy anymore. We're seeing that when it comes to the media, people, alternative media, fake news, and so on, people are consuming information from different sources. When it comes to sports, we have all the doping scandals in sports. So I think the matter of trust is really something that that is important to understand. And when it comes to gold, it seems that last year we have seen the biggest buying spree since the resolution of the Bretton Woods agreements, 1971. So actually, central banks bought 650 tons of gold last year. And it's clearly a sign that governments or central banks, especially Russia, but also China, it is India, it is Kazakhstan, it is Turkey, but also some European Union members like Poland or Hungary, that they're kind of diversifying out of the dollar. And it's not only the central bank buying, it is also the repatriation of gold that is currently happening. So people want to redeem their gold, bring it back into their home countries, and that's a clear sign that trust is crumbling in the monetary system at the moment.
Excellent. I mean, we've recently seen a significant uptick in volatility in the equity markets, especially in the U.S. And in May, the VIX market, the most popular gauge of volatility and investor anxiety, hit its highest levels since January. Many have blamed the U.S.-China trade war for the increased uncertainty. I mean, we saw the gold prices hit new highs last week. I mean, do you agree with that view, or do you believe that there are other underlying forces that are threatening the record-breaking bull market at this point?
Well, I think that's a bit of first-level thinking. I often have journalists calling me up saying, why did gold now just rise $5? I say, come on.
we're waiting for the big moves, right?
Yeah. I think that, when it comes to the trade wars, trade war, first of all, it's an oxymoron. It's in the century before the last century. The Frédéric Bastiat said that either goods cross borders or soldiers do. So I think the trade war is definitely something that is important for markets and especially for politics going forward. But I think most of the things are already kind of priced in, and we can see that the markets are a bit more resilient to tweets out of the White House. I think it would be not enough to say that the trade war and the US-China tensions are the main reason for the uptick in volatility. We should say that first of all, we have seen that in the last 10 years, central banks created out 18 trillion, so 18,000 billion US dollars out of thin air. And actually, the fourth quarter 2018 was the first quarter in 10 years where on a net basis, central banks actually reduced central bank liquidity. So they took base money out of the system. And it was, of course, primarily the quantitative tightening by the Federal Reserve. But also most other central banks became at least slightly more hawkish. And we have seen that, fourth quarter 2018 was actually quite a negative quarter. And actually most asset classes were down. stocks had the worst performing month in December 2018 since the Great Depression. So it was really quite a negative environment. And in this environment, gold perfectly showed what its role is.
Yeah.
Gold was up 7%, mining stocks were up 17%. So gold acted perfectly as a portfolio stabilizer. Now, we have seen in December that this monetary U-turn that we have described for a while already, that this was initiated. And now I think in the last couple of weeks, when the market really shifted, and we shouldn't forget that like 1 year ago, everybody thought or discounted that we will see 3 to 4 rate hikes in 2019. Now the market is discounting that we're seeing lower rates. So 2 or 3 times the Federal Reserve might actually lower rates. So there was a huge shift going on. And this monetary U-turn, from my point of view, is the main reason why we are seeing those big moves in equity markets, in bond markets. I mean, we're inverted in many parts of the yield curve, but also in the stock market. And I think that as an equity investor, you should always buy the last rate cut and not the first rate cut. So recession risks are definitely much higher than the market discounts at the moment.
Speaking of the Fed, I mean, and the anticipated interest rate cut that we're all kind of looking forward to here. I mean, what do you believe would be the implications of a return to a supportive monetary policy direction, and how sustainable do you think that approach can really be?
Well, I mean, I think it's important to say that normally what happens within a recession, normally rates get lowered by 500 basis points. So on a relative basis, the Federal Reserve has ample leeway to lower rates. But if we would go down 500 basis points, we would still be in deeply negative territory. For the other major central banks, especially the ECB, but also the Bank of Japan, there's no such leeway to lower rates at the moment, in case they don't want to go into deeply negative territory. So from my point of view, it is no coincidence that there were some papers coming out recently that further quantitative easing might be appropriate. I think there was quite a lot of academic papers coming out. One, for example, from the Federal Reserve Bank of San Francisco, saying that actually negative rates would have been the best solution in the 2008 crisis, and to fight the next recession, negative rates are the perfect tool. It is no coincidence that everybody is kind of excited about MMT nowadays, modern monetary theory, or as Dave Rosenberg said, magical money tree. So I think MMT. It sounds super sophisticated. Modern monetary theory. Nobody really knows what it is. Yeah. So I think that. Especially as we are facing an election year 2020, I think that MMT will definitely become more important. And actually, you could say that Donald Trump is some sort of an MMT president already, because he kind of massively increased fiscal stimulus at a time when actually we have already seen full employment, GDP growth being quite positive. So actually he prolonged the cycle with his fiscal stimulus. When it comes to MMT, I think in contrast to quantitative easing, it will have a much more direct effect on the inflation rate, because QE has basically directly impacted only the yields of the purchased bonds. And of course, we've seen second round effects, which were kind of inflationary. But MMT, on the other hand, will increase demand more directly and rapidly through higher budget deficits and will probably increase inflationary pressures. And I don't know what will be bought for this MMT money, if it's a Green New Deal, if it's an infrastructure program, or to finance wars, whatever. Politicians can basically pick whatever they want. But I think, although I am, as you can imagine, not really a big fan of MMT, I think it would be naive to just ignore it. So it will become one of the most important drivers for markets going forward.
We're looking at the possibility of another recession here within the next 2 years. And, I guess the next question is, what do you think could be some tools the central banks might be able to use to fight it, beyond the negative interest rates and aggressive QE?
Well, I think that first of all, I think that when it comes to fighting the next recession, I think that many central banks will say, okay, we have already done quite a lot. Now it's really time for the politicians to support us fighting the recession. So I think there will be much more fiscal stimulus than in 2008, 2009. And we have all forgotten about the Occupy Wall Street movement. Back in the days, it was fairly, I would say, peaceful thing. So we didn't see any really big riots. But what happened over the last 10 years, I think the difference between rich and poor, between haves and have-nots, got bigger and bigger. And of course, if you're a holder of real estate, of equities, of art, whatever, of course you appreciate quantitative easing and the whole environment that it creates, because it influences asset price inflation and so on. So we are seeing all over the world that there's a polarization happening, that the middle is breaking away. So it's either right-wing or left-wing populists winning all the elections all over the world. And I think that also some of the root causes of this inequality that we're seeing, and I mean that's obvious, can be found or tracked down if you study and understand our monetary system. Cantillon effect, Richard Cantillon, he explained that already more than 200 years ago. So I think that's going to be the reason why more direct measures such as MMT or helicopter money will be the kind of solution to the next crisis. Of course, we all know that the Austrian approach would be a laissez-faire approach. A recession is nothing else than a reallocation of resources, and businessmen, owners that are well financed, are well established in the market, they will use the recession to pick up misallocated capital, employees, projects, whatever. And actually the basis for the next cycle is more solid and more healthy. But if you try to avoid that natural recession, you just make those reallocations of wasted resources much more dramatic. And this is something, we haven't had a recession in more than 10 years now. I think the next one will make 2008 look like a kindergarten party.
Let's turn our attention a little bit towards Europe. I mean, we have a lot of our readers and clients here at Global Gold that are from the US. So, we like to spend a little time looking at Europe because maybe there's some other angles that they're not used to hearing. I mean, the current climate in Europe is, I would argue that it's a bit more worrying, even with Italy's conflict with the EU over the budget, Germany slowing down, Brexit is still unresolved. Again, after so many years of QE and negative interest rates, do you think the ECB what do you think the ECB has really achieved from this all, and what would you expect the next steps to be in the face of such a anemic Eurozone economy?
Well, Scott, I just returned from a short vacation in Italy, and I talked to many people, and everybody said it doesn't really feel like a recession. It feels more like a depression because there's no perspective. And then I said, I mean, probably because the euro is just way too strong for Italy, and people just stare at me and say, okay. Yeah, that's an interesting answer. We never considered that. So and that was in the northern part of Italy, which is still relatively doing quite well. I mean, the
still doing well.
southern part is a whole different story. But it shows me that when traveling through Europe, it is pretty obvious that the euro is too strong for the southern countries, especially Italy, Greece, Spain, but also for France, while it is way too weak for Germany, where they are just building massive overcapacities. So from my point of view, I mean, we will see a new head of the ECB in fall, and actually. We're still not sure who it's gonna be, but it seems that Mario Draghi will go down in history books as one of the few central bankers that did not raise interest at all in his career. So I think that, and that's what they already kind of said, that 120 euro to the US dollar is kind of the line in the sand. So as soon as we should go over that level, there will be another round of quantitative easing in the Eurozone. So we just published a book. It's still only available in German. It's called Die Nullzinsfalle, which translates to the zero interest rate trap. We are now preparing the English translation. It should be out in fall. But we clearly say in that book that actually on a relative basis, the Federal Reserve did a much better job than the ECB. And if recession clouds become darker over here in Europe, they really have to take very, very aggressive measures over here. And actually, they are in a trap. They not even tried a little to get out of this trap by raising interest rates. And that makes me very, very, very concerned over the longer term. On the other hand, when I'm at international conferences, everybody says, the euro is dead, and you've got all those problems in Italy, in France, also in Germany, and you've got the Brexit and so on. So the euro should go down significantly. And then my reply is, well, those kind of information are already discounted. So from my point of view, due to the big rate differential between the US and the Eurozone, actually, from my point of view, the US dollar should have been much stronger to the euro. So it feels like the US dollar is a bit like a stock that doesn't rise on good news anymore. So perhaps on a short to medium term level, I'm pretty confident regarding the euro, but over the longer term, of course, it has got enormous structural problems. And just one number: since the euro was introduced as book money on 1st of January 1999, gold is up 360% in euro terms. So I think that's that's all we have to say about the purchasing power of the euro.
Yeah, so staying on that subject of currencies, and I know you touched on it as well quite a bit in some of your presentations lately and in the Gold You Trust report. But gold's performance over the last few months, it becomes especially striking when one looks at the price in relation to the other major currencies. Beyond the dollar and the Swiss franc, where gold is hit or is at near all-time highs. Do you think it's important to consider this big picture trend, and what does it say about fiat currencies versus gold in general?
Well, I mean, in the gold report, we often kind of criticize that everybody's just staring at the dollar price of gold.
Yeah, yeah.
While over here, for example, for us, it's more important to follow the gold price in euro terms or in Swiss franc terms. While when you're sitting in Australia, you shouldn't care too much about the US dollar price of gold.
Right.
And actually, I think it's staggering, and that there's a huge divergence between public perception and actual market price action. People just cannot believe that gold is trading in all-time highs in so many currencies at the moment. So in Aussie dollar terms, in Canadian dollar terms, gold is very close to new all-time highs. We're seeing that the world gold price, so gold in a kind of trade-weighted dollar, is also very close to new all-time highs. In dollar terms, gold is up 5% since the beginning of the year. In Aussie dollar terms, it's up 8% since the beginning of the year. Swiss franc up 7%. So the performances, I think, are quite decent, but still nobody is not really talking about gold, and most people, especially in the financial markets, they still think gold is super boring and it is dead. And actually, and I think that was one of the key takeaways from the last In Gold We Trust report. I think that this technical Rubicon at 1360 to 1380, this is really crucial. So we said that because of the correction that we have seen in fourth quarter, which was a big warning shot for most generalist investors. I think that many investors are waiting on the sideline, and actually they want to start buying gold. But it seems that they need some sort of confirmation by the market, and they're not really yet there to buy into it, because the gold doesn't have enough momentum and so on. And those type of money managers always only buy the stuff that has already gone up. So they don't act contrarian. But if we go above this 1360, 1380, I think this will be the starting point when there's gonna be institutional demand kicking in, private bankers start buying gold, the media will get more positive, analysts will raise their forecasts and so on. So this is really something where we'll see a big shift from one stage of a bull market to the other stage of the bull market.
Do you think the way the prices shot up last week here in mid-June, I mean, is it time? Is the next bull market ready to roll right now?
Well, I think it's very encouraging price action, and actually normally every time we publish the In Gold We Trust report, end of May, beginning of June, gold goes down. But this time it went up. So I think it's not because of our influence on the market. We've just been plain lucky. But it seems that there's something happening. Although for the short term, I would say that the Commitment of Traders report is not really encouraging. We have seen that the sentiment quite quickly became very positive. So I think we will be in for a breather for the next couple of weeks. But going forward, I think we can see 1450 to 1500 pretty easily in the next couple of months.
Okay, excellent. And let's not forget about gold's cousin, silver. What do you think is silver's outlook?
Well, of course, from my point of view, silver price could also be interpreted as a sentiment indicator for gold. And strong bull markets for silver usually only happen because of rising gold prices, because investors seek higher leverage, and they end up with mining stocks or with silver. So at the moment, gold silver ratio is at 89, which clearly shows that there's not too much momentum yet, and that there's no trend strength in silver at all in the last couple of weeks. And this shows me that we're not there yet. But it also shows that this extreme relative valuation is an opportunity for people that want to have some leverage on the gold price and want to invest in silver, because we all know that silver is a tiny market. And if our basic assumption of a changing inflation trend proves to be correct, then silver probably is one of the best investment opportunities.
And it's certainly attractive right now as the pricing. So why not dive in? I think a little bit.
Yeah.
Hey, Ronnie, given the increased economic and geopolitical uncertainty that we're looking at right now, I mean, what would be your advice for individual investors who want to protect and preserve their wealth, and what role should physical precious metals be playing in that strategy?
Well, I tend to say that I am not a radical gold fundamentalist. For me, gold is not a religion. Gold is hard money. It is the hardest money that is around. It is probably the best portfolio insurance that you can imagine. In the previous In Gold We Trust report, we crunched the numbers how gold acts in the various stages of recessions. And gold has an excellent track record as a hedge in times of recession. Gold has an excellent track record as a portfolio stabilizer in times of bear markets in equities. So, I cannot put on a number if it should be 5, 10, 15, 20% of gold, but at least you should have some gold. And I think it's just prudent to at the moment where we're currently in most markets, be it real estate, be it equities, be it the art market, and of course bonds. 12 trillion US dollars of bonds are in negative territory at the moment. They're at all-time highs. So it is prudent in the course of this everything bubble to have some insurance, and I think gold does the job pretty well. It is an asset that could also be called the anti-bubble at the moment, because nobody really cares about it.
Yeah.
While, for example, in 2011, when we were trading at 1900, all the major Wall Street banks had really high price targets out. So they were around 2,500 up to 3,000 US dollars price targets. At the moment, everybody just expects gold to go sideways for the next couple of years. Nobody is expecting a recession. So I think if recession fears should be discounted more and more, this will be a huge shift in positioning in markets, and gold will definitely profit from that.
Excellent, Ronnie. Well, thank you. I'm going to conclude our discussion today. I have to guiltily admit that one of the first places I like to look at the In Gold We Trust report is your conclusion, or the Quo Vadis Aurum, at the scenarios you see for gold. To wrap up here today, just give us a few key points we should walk away with, and what scenario do we find ourselves in with gold at this moment?
Well, I think that the key takeaways are, first of all, that inflation is not a concern yet, but we're seeing many indicators that actually inflation is on the rise going forward. It might be anecdotal evidence, but we have seen in April that Business Week came out with a headline, with a cover saying that inflation is dead, which reminded us to the infamous the death of equities back in 1979. We are seeing that gold is actually relative to stocks, relative to bonds, relative to some monetary aggregates, it's very cheap. So that's definitely a key takeaway. We are seeing that the de-dollarization is picking up momentum. It really went mainstream. So we're seeing most of the emerging markets, and 70% of all the gold demand at the moment is coming out of emerging markets, that they continue to buy gold, not only Russia and China, but also many other emerging market countries. We are seeing that mining stocks, they have seen the creative destruction happening in the last couple of years. They became much leaner and more solid. So this is definitely an asset class that one should have a very close look at it. We are seeing that gold is trading at all-time highs in many currencies, and we're seeing that everybody is just staring at this big resistance zone, and once we're above that, we should go to, as I've said, to 1500 pretty easily. When it comes to the scenarios, I think we are still in a scenario B that we are outlining in the report, which is the muddling through scenario. And I would not rule out that if this monetary U-turn continues, that we might go into scenario C or even into scenario D, and this would, of course, mean significantly higher gold prices.
Excellent. Ronnie, thanks a lot for your time today. For our readers and our listeners, definitely check out the In Gold We Trust report, and you can learn more about those scenarios and definitely more detail on a lot of the things that you've talked about today. Ronnie, once again, thanks a lot for joining us today.
Scott, many, many thanks. I really enjoyed it. I hope that you and your listeners also enjoyed it. And yeah, check out the new In Gold We Trust report. It's a pretty heavy reading. We hit a new all-time highs with 340 pages, but there's also a compact version which is still 100 pages. So enough material to study for the summer holidays.
Thank you.